Hello, welcome to this week's Market Carver. I am Andrew Thrasher, Senior Portfolio Manager for Financial Enhancement Group, joined by Zach Unger, Portfolio Manager. We have a continuation of some of the topics that we've been hitting on, but looking at them continuously through a different angle. We're going to start looking at tech and a pretty interesting real estate listing that you may find interesting even if you're not in the market for a new home. And then Zach's going to close out with looking at the fixed income market. So first, we're going to go all the way over to San Francisco. There's a recent house listing that's gained a lot of attention lately, not because that it's almost $3 million for less than 3,000 square feet, but if we look at the About Home section, we're going to zoom in on it. It's the fact that the developer who built this home is actually saying they're going to accept Anthropic or OpenAI stock as payment. Anthropic is who runs Claude, OpenAI, that's ChatGPT for those less familiar. It's the idea that there's been this mania around the AI space, and the fact now they're actually starting to accept payment to buy property with private company stock. Not something we see very often, and kind of gives us a little bit of insight to some of the frothy sentiment towards this mania towards OpenAI and just the general AI consensus, semiconductors and tech, and just the massive interest to be in this sector. We're seeing companies coming out. One very popular social media company said he'd rather go bankrupt than lose the arms race in AI. It's just really, really getting pretty frothy there. And we can see that because of the strength in this AI theme, rolls over to the tech sector. When we look below the hood, something we do a lot in this Market Carver, wanting to evaluate, are we seeing a lot of stocks go up, a lot of stocks go down, kind of determine the health of a market. We can see a big separation when we look at the next slide between how many stocks are going higher in the NASDAQ 100. That's going to be where we're getting a lot of our tech stocks and things like that. We're seeing continuation of those lines going higher and higher since the March 30th low. This is giving us good expansion in participation. We're seeing more stocks rally along with the index. However, if we broaden that view and look at the Russell 3000, which that gives us a look at not only the largest stocks, but the large, mid, and small cap stocks. So a really broad view of the market. We see a different picture here. In fact, we see less and less stocks making new 3-month, 6-month, or 12-month highs, showing that we're not seeing that broadening out when we look a little less focused on just the tech or those high beta NASDAQ 100 stocks. So this still gives us a concern. This doesn't mean the price immediately has to follow. In fact, price has been ignoring this development for several weeks. And so it's something we really want to understand, that while there may be clouds in the sky, doesn't mean that it has to absolutely rain, that we can continue to see the sunshine, that UV index can stay high as long as price is able to continue to rally on those few stocks that are continuing to move higher and being relegated on that NASDAQ 100 side. So that's what's happening right now on the equity side. Going to turn over to Zach, who's going to give us a look on the fixed income side of the market.
Then we're going to take just a second to talk about the current interest rate environment. This in particular, the chart on your screen, is the real Fed funds rate. The real rate, as a refresher, for those of you who may have forgotten since econ class, is the headline rate, or in this particular instance, the rate that the Federal Reserve sets, the interest rate, minus inflation. So you want to focus on the blue bar on the chart here. It can be a little bit confusing, but we're going to try and simplify here. The blue bar is economic expansion, or the average real rate through different economic expansions going all the way back to the 1960s. So a couple things immediately jump out here as you look at the blue bar. The blue bars in the center, back in the late 70s, early 80s, when the Fed was trying to crush rampant inflation, interest rates shot up. Ever since then, we've had this steady decline through these economic expansions of the real interest rate. Now, the real interest rate is important because although the nominal interest rate, or the interest rate that the Federal Reserve sets, is the one that gets the headlines, the real interest rate is actually what tells us the impact on the economy, or how cheap or expensive money is, because it backs out inflation or offsets it against inflation. So on an inflation adjusted basis, going all the way back to the 70s, money has continued to be cheaper and cheaper and cheaper. The second thing that jumps out is that we're actually in the current economic expansion at negative real interest rates, meaning that even though the interest rate that the Federal Reserve sets may feel restrictive in view of the current inflationary environment, it's actually a little bit loose, one might argue, or even neutral. And so the couple implications that we think are key here: one, the interest rate hikes that were on the table, the several that were on the table going back to last year, even as early as this year, may not be as likely because the Fed in real rates term is actually pretty neutral right now. There's not a lot of wiggle room to continue to adjust it downwards because inflation is still pretty high and pretty sticky relative to their mandate. And so we should expect interest rates to probably stay a little bit higher for longer. That's not necessarily a bad thing. It means that yields on cash or cash equivalents should continue to be pretty attractive. And then the other piece here is that we did get a new Fed chair that was sworn in May. And the inflation metric that he has come out and said that he prefers actually tends to bring the inflation reading down a little bit. The way that the formula works for real interest rates is the nominal interest rate minus inflation. And so if inflation is a little bit lower, your real rate is going to appear higher. We're not necessarily saying or predicting that that will lead to interest rate cuts, but it does muddy the waters a little bit based on how the real rate would read. If inflation, based on the new preferred reading of the new Fed chair, if that were to come in a little bit lower, it may, in the real interest rate environment or the real interest rate data, give a little bit more wiggle room for Fed rate cuts. But what we're expecting based on the data here, real rates being pretty neutral, is that we're probably going to see a higher for longer scenario, and that rates aren't going to be cut anytime soon.
All right. Thank you, Zach. That's the market curve for this week. If you do have any questions or you'd like to set up an appointment with any of our advisors or staff on our team, please give us a call on the phone number on your screen, the URL on your screen, or the QR code. Many ways to reach us. Thank you so much and have a great week.